I'm Max Keiser. Welcome to the Keiser Report. More algo bots and civil suits in today's headlines. Wells Fargo has just been charged with civil mortgage fraud as opposed to the unfriendly or surly sort of mortgage fraud that mere mortals engage in. While in matters of law, civil, of course, means you're not being charged with a freaking crime. According to thesaurus.com, civil is also synonymous with amiable, benevolent, benign, clubby, cordial, courteous, cozy, like-minded, neighborly, sympathetic indeed. Stacy Herbert, tell me more. Civil, oh great civil. Civil? Not civil, but civil.
Well, I did think the synonyms were great for these constant parade of civil suits against hardcore financial criminals. It's very clubby and cozy and benevolent, and they're helping each other out. So the headline is from Bloomberg, U.S. files civil mortgage fraud against Wells Fargo. Now again, with that in mind of the amiable suits, read what the U.S. attorney says. As the complaint alleges, yet another major bank has engaged in a long-standing and reckless trifecta of deficient training, deficient underwriting, and deficient disclosure, all while relying on the convenient backstop of government insurance.
Right. So it's a question of semantics, you see. They're engaged in civil wrongdoing. The clubby atmosphere has been interrupted by the imposition of the rule of law and the natural law and the social contract. Oh, golly gee, how can we continue to underwrite this fraud if somebody keeps making a stink about our use of the word civil? Don't use the word criminal. Criminal would imply that we're doing something illegal.
And, you know, here in London, they changed the Financial Services Authority to the Financial Conduct Authority. And again, it fits in with that. This is deficient training, deficient underwriting. So we're moving further and further away from that justice that most people in the world are seeking at this moment.
Well, this is a crisis of justice for sure. This is a huge problem around the world. People are seeking social justice. It's not so much this 99% versus the 1%. It's not so much that the wealth is being confiscated by the top criminal elite in the city of London and Wall Street. It's more about the problem of there being a complete lack of justice. The law, for some, is something that they write for their benefit. And then when others try to go to the courts with the same type of standard, they are immediately put into a straitjacket and beaten to within an inch of their life by the goons and thugs.
Well, now with this in mind, again, you know, these crimes that Wells Fargo is alleged to have committed, very civilly perhaps, they were committed many, many years ago. So let's look at some of the suspicious and mysterious and crazy activity going on in the markets today that in 10 years' time might result in a civil lawsuit. Mysterious algorithm was 4% of trading activity last week. A single mysterious computer program that placed orders and then subsequently canceled them made up 4% of all quote traffic in the U.S. stock market last week. Max, they say that the motive of the algorithm was unclear.
Yes, a mysterious algorithm was gobbling up the New York Stock Exchange and making a few people fabulously wealthy. A mysterious parasite called Jamie Dimon was swimming in the entrails of the lower intestines of the New York Stock Exchange, and he was getting fat on stealing money, along with Goldman Sachs and Barclays and who's this new guy in town? Martin Schlingflonger. Martin Schlingflonger.
Martin Wheatley.
Martin Wheatley, here in the UK. He's a parasite crawling up the schwing of the alimentary canal of the banking system, engorging himself on the fraud. He's getting fat, Martin Wheatley, on the fraud. He's a parasite, Martin Wheatley.
Well, again, Max, the motive of the algorithm remains unclear.
There's nothing unclear about the motive of the algorithm. It's about stealing money. That's the way it's designed. That's the way it's written. They get all those Sharpies down there in the city and the Wall Street and MIT and Stanford University to create algorithms to steal money. That's not ambiguous. How can you say, oh, we just accidentally made money again? every single day for 90 days in a row. We're reporting to the SEC we made money every single day, 90 days in a row. Accidentally. Oh, I accidentally found this wallet full of money in the same spot every single day for the last 90 days. That's not an accident. That's called stealing.
So, again, the motive of the algorithm remains unclear. So I'm saying that in 10 years' time, when it's put before a jury of its peers, this algorithm, it's going to be a whole bunch of computers there in the jury selection to judge this algorithm, whether its motives were criminal or just normal high-frequency trading.
Your Honor, I was employed by Goldman Sachs to steal money. I am an algorithmic robot. I do not know why I had to do what I did. My brain has been programmed by Lloyd Blankfein and Jimmy Diamond to steal money. Please, Your Honor, do not put me with the other robots in the robotic jail. Please, please. I am innocent, Your Honor. I am innocent.
The program placed orders in 25 millisecond bursts involving about 500 stocks, according to Nanex, a market data firm. The algorithm never executed a single trade, and it abruptly ended at about 10:30 a.m. Friday, which is probably when Nanex first made this information public, and it just immediately shut off to disappear any trace of its crime.
Well, amazingly, the crash of 1987 was caused by algorithmic trading gone amok. So, in response, they made it do more faster. So they're putting even greater risk into the systemic risk and causing more problems. That's the lesson so far during the crisis, which actually goes back to the 1987 stock market crash. The lesson has always been, make it faster, make it more dangerous, and let's steal more money.
Speaking of stealing money, now this algorithm was 4% of all quotes on the market, but it was 10% of the bandwidth available to the market. So CNBC reckons that the ultimate goal of many of these programs is to gum up the system so it slows down the quote feed to others and allows the computer traders with their co-located servers at the exchanges to gain a money-making arbitrage opportunity. Again, Max, look at the phraseology here. To gain a money-making arbitrage opportunity. Usually that would be a criminal activity to steal something. They're not gaining an arbitrage opportunity. They're creating one that they engineered.
Right, they're not gaining, they're gaming. You see, there's a difference here. Talk about semantics. But, it's like that movie, The Sting, if you recall. At the end of the movie, there's a scene where they run a horse scam, where the results are reported at a different information than everyone is available in the parlor there to make the bets, you see? And that's exactly what they're talking about here. They're affecting the speed of which the trades are being reported and then cashing in on the market's inability to get real-time data. So this is just it's just an old classic scam, the tape scam from horse racing days applied to stock markets in milliseconds. But it's the same crime committed, but just faster with more money.
Now, Eric Hunsater, the head of Nanex, says that this trading activity, this suspicious, mysterious algorithm with no clear motive, he says it just goes to show you how just one person can have such an outsized impact on the market. Exchanges are just not monitoring it. Well, we covered a few weeks ago that the New York Stock Exchange was actually engaged in it. Remember, they had a feed that was fed at 2 milliseconds to their preferred clients during the flash crash, while the normal everyday market participant was receiving information at 5.3 seconds. So way behind the insiders.
Okay, well, absolutely correct. The New York Stock Exchange has sold the privileged seat to front run on the exchange. They also have allowed firms to co-locate, put servers next to the New York Stock Exchange to get an advantage in what's called high frequency trading, which is just like siphoning off cash for free.
Well, actually, Max, it's not siphoning off cash. That language is far too surly for this. It's to gain a money-making arbitrage opportunity.
Right, exactly. I'm sorry.
So now, speaking of all this insider trading, rigging indices, rigging markets, we have this headline: LIBOR gate comes to crude. Total exposes price fixing in the energy market, or I guess you should say Total. Well, there's a whistleblower at Total in Switzerland. Apparently, the IOSCO, the International Organization of Securities Commissions, had sent out a letter requesting advice from all the participants in these oil markets. And what happened is that this whistleblower from Total said that basically they have warned over inaccuracies in price benchmarks. And that the inaccurate pricing provided by these benchmarks, Platts and Argus, for example, don't represent the reality on the ground, i.e. there's rigging. As we've covered here with Leah McGrath-Goodman and also Chris Cook, they both suggested the same exact thing on different sort of ends of this market. Chris Cook with the London end of it and Leah McGrath-Goodman with the US end.
Right, the benchmarks that they use to trade off are rigged. So it's exactly analogous to the LIBOR rigging scandal, where the benchmarks and indexes are rigged, and then all the trades that surround the benchmarks and the index are privileged information on the inside to capitalize on the arbitrage of having an asymmetric market, of having the vast population of people in the markets totally deaf to what is actually the true price signal, and then you have a few insiders who are capitalizing on this huge gap of market distribution, and then they take that money and they go buy themselves a Mitt Romney.
Well, the insiders who were very happy with it are BP, Saudi Aramco, the very people that Chris Cook says could be involved in this. He's told us on the Keiser report many times over the past 2 or 3 years. Now, the whistleblower from Total says it is not simply an issue regarding the pricing of OTC contracts. Margins for refiners and retailers, as well as prices for end users, are directly impacted by erroneous prices. So again, if Martin Wheatley sort of guy is the one that is going to come in, now we see what they've done with LIBOR. They're going to say in the future, this sort of oil rigging might be illegal.
Well, the other major point to make here is that oil companies make more money rigging the system and trading on inside information than they do in buying and selling and drilling and processing oil. The same thing as banks. Banks make, in the City of London, make more money rigging LIBOR than they do making loans and doing the normal functions of a bank. And this is the problem in this economy in the city, in New York, around the world, is that the crime wave that is the core of the global economy has contributing now the majority of profits to these G20 nations. So if you start to really dismantle these criminal syndicates, you are going to suffer an enormous economic crash. But you know, the problem is when you have an infestation of these parasites, you need to flush them out. Otherwise, the parasites will eventually completely consume the host. And that's what's happening in the UK, in the US, around the world. The parasites on Wall Street and in the city are consuming the host. That's me, that's you, that's you. You're being consumed by the parasites in the banking industry.
Yes, and for this information to emerge, we relied on this whistleblower who came out. And regarding this, you know, the Financial Times says about this whistleblower, the unusually candid public comments by trading arm of Total have broken the omerta of the energy physical trading industry, a close-knit community in London, Geneva, Singapore, and Houston, where disputes are usually settled in private.
A very civil affair. A gentleman's agreement to rig the markets. Thank you, Stacy Herbert, for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Paris and talk with Jon Najarian of OptionMonster.com. Jon Najarian, for those who don't know, what is option trading? What role does it play in the overall markets? And welcome to the Keiser Report.
First of all, Max, delight to be here. Enjoyed your reports for years, and now I get to actually be on with you, so I'm flattered. What role does it play? Options, of course, are a derivative that lets people use leverage in their favor, or unfortunately for some people, use it like fire and they burn themselves. But overall, options trading, in particular in the U.S., has really exploded lately. And I think some of that, Max, is because of stocks like Apple and Google and Amazon that are so expensive to trade, people can take just a much smaller piece of that by trading with options. And now they have options that not only expire on a monthly or quarterly basis, but weekly basis. and that has also really sparked a lot of enthusiasm and interest in the product.
Well, I had actually no idea. You know, I was a big options trader at Shearson during the 80s. I was their third or fourth biggest options producer in the entire 10,000 broker system. And that's amazing that now they have weekly options, and I guess I understand tied to these very high-priced stocks like the Google stock and the multi-hundreds. You can't really buy shares of these stocks. You're forced to buy options. And just to reiterate, an option is kind of a bet on which way a stock is going, up or down. Now, the Guardian newspaper in London has recently wrote that the Black-Scholes equation was the mathematical justification for the trading that plunged the world's banks into catastrophe. In particular, it says, quote, "It was the Black-Scholes equation that opened up the world of derivatives." Okay, so, John, going back to the late 70s and early 80s, tell us about the Black-Scholes option pricing volatility formula.
Sure. Well, basically, folks, since, as Max said, an option can give you the right to buy something or the right to sell something. So a call option is the right to buy something. People try to figure out what is that option on buying Apple at $650 a share worth. So they basically plug it into a formula. The Black-Scholes model is the one Max is talking about, but there are 5 or 6 others that people developed over the last few years. And it's a formula that basically calculates along a bell-shaped curve and figures out the possibilities of various outcomes. And that there are knowns, of course, like how much time until expiration. If it's a weekly option, there are 7 days or 2 days or even just 1 day as you get into the final days. Interest rates are pretty known. The price of the stock and the price of the option, those can move, of course, with volatility. And so that concept of volatility, Max, which you saw in 1987 explode to record levels, that is one of the key components of options. The more fear there is in the marketplace, the greater the potential movement up or down for that particular asset, and that influences the price of the option.
All right, let's talk about, for example, a stock like Google. For an example, let's say it's trading at $700 a share. Now, I think people can readily understand that if you want to make a bet that the price is going to go above $700 a share, and that bet would be based on the current price of $700 a share, and therefore you're going to pay for an option. But what people might not really readily understand is that you also have the ability to buy an option based on the price going to 105, 110, 115, and 120. So you're buying effectively an option on a theoretical price, and that's where this formula or volatility formula comes in, the Black-Scholes. This is what's so important, is because it allows the market to give a price to something that's way out of the current price. Where only volatility exists, there's no intrinsic value. Your thoughts?
Yeah, exactly, Max. And that's why a lot of people look at it as some sort of science, what we do every day in trading options, what you did for years and years at Shearson. Because if something isn't in money is known as intrinsic value, folks. So in other words, what Max described, of course, is out of the money, either out of the money bets that the stock goes a lot higher, or out of the money bets underneath the market that would be a bet that the stock is going to go down. Now, people profit very, very quickly on those panic bets to the downside. You need look no further than Apple recently, as it fell from $700 about 2 weeks ago all the way down to $620, an $80 price drop just in the last 2 weeks. That was, of course, one of those events that isn't really a known event. There was, some talk about factory closures and things like that, and maybe the mapping function didn't work so well. But basically, when that snowball gets rolling downhill, it goes down faster than, of course, it goes up. And that's why those put options, the bet that the stock price will decline, are so popular in bear markets.
All right, John, you mentioned that once the ball starts rolling, it starts to gather velocity and speed quite quickly because there are more options trading based on a company's stock than there is stock in existence. So if Apple or Google might have 100 or half a billion shares outstanding, there are 5, 10, 15, 20 times that number of shares in the options market trading in the derivatives market. So you've got this enormous leverage, don't you? But I wanted to just bring in another point quickly, which is that you mentioned out-of-the-money options. Let's talk about an out-of-the-money put option. That is a bet that the stock's going to go a lot lower, and if it's 10 or 20 bucks below the current price, you might only pay 10 cents, 20 cents, or 30 cents for that option. Talk to me what happens when a flash crash happens. And in other words, a flash crash happens, which is again caused by this extreme volatility, by the presence of this extreme leverage and these extreme derivatives. Isn't it not in the interest of somebody who has an out-of-the-money put bet to cause a flash crash? And is there, in your knowledge, Jon, any indication that we have instances where traders who are positioned ahead of these flash crashes are actually helping to contribute to them, to profit from them? Your thoughts?
Absolutely, Max. In fact, I've heard you rail about high-frequency trading and flash crash in your reports before, and kudos to you for doing it. High-frequency trading is one of those things that can promote or create a flash crash because all of a sudden a bunch of machines lower their bids simultaneously, and we're talking nanoseconds here, folks. And since they've taken so many people out of the market, there aren't the thousands of market makers that there used to be when Max was talking about the 80s. Gosh, Max, there were 5,000 or 6,000 option market makers on the floor in the United States. Now there are probably, I'll guess, 800 collectively across all of the exchanges in the United States that are on the floor. Now it's all just run by algorithms. So when you get a flash crash, there are certainly some people who could buy those out-of-the-money puts, betting that the market could decline, and then try to get that snowball rolling downhill very quickly by creating volatility and that fear in the marketplace, knowing that all the other algorithms will react to it by lowering their offers and lowering their bids. And since they do this virtually simultaneously in nanoseconds, you can see stocks fall very, very quickly, so that bet could pay off, and that leveraged bet could make somebody a lot of money.
Well, Jon, I can see we only have a few minutes left. When we're talking about options, I could go on and have this conversation last an hour or two, but let's get to some quick points here. Speaking of equations, high-frequency trading, CNBC just reported that mysterious algorithms was 4% of trading activity last week. They also said the motive for the algorithm is still unclear. So your thoughts on high-frequency trading, and is it fair to say that the motives are unclear? That seems remarkably vague.
Yeah, and it seems rather not very educated either. And clearly you and I aren't talking about it that way. I think the motives are very clear, Max. I think when somebody creates an algorithm that seems to be the intention of that algorithm to seek out bids and offers, we would call it back in the old days of futures trading, looking for stops, stop orders that are placed below the market, where somebody's looking to trigger that stop order and cause a waterfall, cause that stock or that future to roll over. I think many of these algorithms are created very much with that in mind. In other words, it's very transparent to me, not opaque, that the people creating many of these algorithms are doing so to create mayhem in the markets. I believe, of course, it should be investigated very thoroughly, but unfortunately, in many cases, the regulators are asleep at the wheel.
The Economist magazine reported a couple of months ago a report that was leaked or made visible accidentally from lawyers representing Goldman Sachs. And in this report, it said that the company was, in fact, engaged in naked short selling. That is to say that they were selling contracts that did not exist. More shares, for example, in Lehman Brothers, when Lehman Brothers collapsed, more shares were sold short than actually existed in the float. I see you kind of smiling about this. It's the first time this information went public because many people deny that naked short selling ever even existed. Your thoughts? What's your thinking on this?
I've seen it for years, Max. I believe you have too. Naked short selling folks, instead of acquiring, because when a short seller sells the stock, they have to go borrow that stock from somebody else to satisfy the delivery. Because there's supposed to be a fixed amount of stock, whether it's 100 million shares or 1 billion shares, and you're not supposed to be able to sell more than exists in the case of the stock. And in some cases, Lehman Brothers being one of those, if you had a very strong feeling that the stock was going to be going to zero, and you said, well, but it's trading at $25. If I can sell 2 billion shares worth of it at $20, when it goes to zero, I'm going to make an awful lot of money. I think that does happen, Max. I'm sorry and sad when, like I say, the regulators aren't paying enough attention, because their job is really to protect us. Whether I'm a professional trader or whether I'm investing as a casual retail investor, the regulator's job is to protect us. And when they fall down in that responsibility, their fiduciary responsibility, it hurts all of us. So the credibility of Goldman Sachs obviously is in question because of that report in The Economist, and obviously the credibility of the regulators, who should have been on top of it, should have made sure that these guys had a good borrow before they sold that much stock. That is one of the problems with the markets today.
John, we're out of time. We'll have to have you on again soon. Thanks for being on the Keiser Report.
My pleasure, Max. Thank you.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Jon Najarian. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.